Welcome to the video TFSA versus RSP contribution presented by PAPE Canada. In this particular video, we're going to strictly compare what happens when you make a deposit into a tax-free savings account and or an RSP, all things being equal. If you are looking for a specific video about TFSA plans or RSP plans, those are done separately. And so we can link to those, that's not a problem, and you can watch those if you need information on either plan type. In this video, we're just going to compare the two of them. Now, as I'm sure you're aware, a tax-free savings account, you take money that you've earned, you've paid tax on, and then you deposit it inside of the account. The growth inside of the account, as well as the withdrawal, are tax-free. The RSP, you put money in and you get a tax deduction, meaning it's pre-tax money. All the growth inside the plan is tax-free until you withdraw the money, at which point you pay tax at your marginal rate of tax. By the end of the video, you're going to have learned that it's really not about comparing the two plan types, but it's about you, the plan owner, and your marginal rate of tax during your pre-retirement years, so while you're working, in comparison to your post-retirement years, so while you're retired and drawing down on the money. So in this particular video, we're going to run through an example with numbers. I've already verified the numbers. I have a calculator. You're free to follow along with me and do the calculations as well, but you don't have to. I'm going to go ahead and do them. So we're going to start with the easy one, which is the tax-free savings account deposit and withdrawal. We're going to assume that $10,000 is being deposited. We're going to assume that the rate of return is 8%. And we're going to assume that that return is happening over a 25-year period, every year for 25 years. And then we're going to calculate how much will be there at the end of it. And that way we can compare it. So I'm going to do 1.08 y to the x 25, or of course you can do 1.08 times 1.08 times 1.08 25 times. I will then multiply that by $10,000, and I get a future value of $68,485, and I'm rounding off the cents, okay? So that is how much is there at the end of the 25-year period, and that is money right into your pocket, or you probably can't see that, right into your pocket. That's your money net after tax, because there are no taxes, okay? Now, we're going to just kind of put that on the side, and we're going to compare it now to the RSP, contribution, growth, and withdrawal. Of course, what ends up happening with an RSP is that you get a tax deduction for your deposit. So when you earn $100,000 a year and you put in $10,000 to the RSP, which we're going to do again, $10,000, we're going to assume that the rate of return is 8% for a period of 25 years. We have to ask ourselves, well, what happens with that? Because if we're putting in the $10,000 and we're at a marginal rate of tax of 35%, well, we're going to get money back here. We paid tax on this amount that we didn't have to. So $10,000 is actually more than that. So unless you're really in the know and you're in the industry, this is where people make the mistake. They forget to start off by calculating $10,000 divided by 1 minus the marginal rate of tax. And so if we take our calculators and we do 10,000 divided by 0.65, we end up with $15,385. That's our starting point. Because the whole point of putting money in the RSP is that it's pre-tax income. You haven't paid taxes on it yet. So you actually start with $15,385. So we take that amount, and again, we go back to our example. We start, instead of the $10,000, we start with $15,385. We go 1.08. Y to the x 25 is equal to, multiplied by 15,385 is equal to a future value of $105,364, and I'm rounding it upwards. That is the gross amount inside of the RSP in 25 years, and now we withdraw it. Remember, while we were working and we made the deposit, we were in a 35% marginal rate of tax. During retirement, most Canadians will be in a lower marginal rate of tax. You could be at the same marginal rate of tax. You could also be at a higher marginal rate of tax, but that's quite rare. So we're going to assume you're at the same marginal rate of tax so we can compare it side by side. So we have the 105,364. We're going to multiply that by 0.65 because that's what's going to be left. And that amount is equal to $68,486. Well, we rounded it, so we're off by $1 here when we compare the RSP to the tax-free savings account. We're off by $1. It's a rounding error. So what happens is this. If you're working and during your pre-retirement years, you anticipate being in the very same marginal rate of tax in retirement as you are today, then there's absolutely no difference between a TFSA contribution and an RSP contribution at the end of the road in 25 years, all things equal. If, however, you anticipate being in a lower marginal rate of tax in retirement versus today, then as an example, if it's a 25% marginal rate of tax in retirement, we have the 105,364 multiplied by 0.75, and we would be left with approximately $79,000, which is $10,500 or so more than in the tax-free savings account. Now, if you're pretty certain that you're going to be in a much lower marginal rate of tax during your retirement years, the RSP plan makes a lot of sense for you, assuming you're not going to need the cash flow. If it's very, very close, what ends up happening, you have to ask yourself, am I making this contribution because I really need the tax refund? Well, what happens in 6 months? If you still need the money and you're going to pull it out of the RSP, that's actually detrimental. When you put money into an RSP and take it out early, that unused room is not given back to you. You've basically lost it for good. So on that, I'm going to leave you with that example. This is the numbers example as to which one is better. If your marginal rate of tax is the same pre-retirement versus retirement, then they're the same. If your marginal rate of tax in retirement will be higher, it's detrimental to use an RSP. If your marginal rate of tax in retirement is lower, then you're better off using the RSP, all things equal. On that, I hope you found this video informative. Thank you for watching.